Have you ever felt like the world of business has its own secret language? Well, today, we're going to crack that code. We are diving into the fundamental rules that turn all those business numbers from just confusing noise into a story that you can actually understand.
I mean, just think about it for a second. What if every single company just made up its own rules for reporting profits? How could you possibly trust an investment? How would a bank ever decide who to give a loan to? It would be pure, unadulterated chaos.
And that really gets us to the heart of it. These rules are basically the grammar of business. They're the structure, the shared understanding that stops everything from descending into that chaos. Without this grammar, it's all just financial gibberish. So what exactly is this grammar? Well, it's not just one single idea. It's a whole system of rules. Let's start by breaking down what we're really talking about when we say accounting principles. Okay, so at their very core, accounting principles are the foundational rules for how you record and present financial information. And the ultimate goal here? It's to make sure that everyone, from a tiny local business all the way up to a massive global corporation, is speaking the exact same financial language. But it's not just one big, messy pile of rules. There's actually a pretty clear hierarchy, a structure that flows from these really broad ideas all the way down to the specific actions a company takes. And understanding this structure is the key to seeing how the whole system actually holds together. And a huge part of this is getting the difference between principles and standards. Think of it like this. Principles are the why. They're the big picture philosophy. Standards, on the other hand, are the detailed rule books, the specific how. This is where you get things like GAAP in the US or IFRS, which is used by most of the world. They're the practical, nitty-gritty application of those big ideas. So you can see the flow here. It starts with that core philosophy, the principles. And those principles inform the detailed rule books, the standards. And then individual companies make their own specific choices within those rules, and that creates their policies. Like choosing a specific method for how they depreciate the value of their equipment over time. All right, now for the main event. Let's get into the essential rules of this financial language. We're going to break down these 6 core principles that really form the bedrock of all modern accounting. First up, we have the going concern principle. This is the baseline assumption that a business is going to keep operating, that it's not going to shut down tomorrow, and this is crucial. Without it, you'd have to value a company's assets at their fire sale price, which would make almost every healthy company on the planet look like it's about to collapse. Next, the consistency principle. This one's simple but incredibly powerful. Once you pick an accounting method, you have to stick with it. Why? Because this allows for a true apples-to-apples comparison of a company's performance from one year to the next. If a company could just break this rule, they could easily hide a terrible year just by changing how they calculate their inventory, making it impossible for investors to spot the real trend. Now, the accrual principle. This one is huge. It is the absolute foundation of modern accounting. It means you record a sale when you earn the money, not necessarily when the cash actually lands in your bank account. This gives you a much, much more accurate picture of a company's actual health. A business that ignores this might look fantastic because it just collected a huge payment for work it did last year, all while having 0 new sales this year. See the problem? Then we've got the cost principle. This says you record an asset, like a building, at what you originally paid for it, not what it might be worth on the market today. Now that might seem a little weird, right? But what it does is prioritize objective, verifiable data over these subjective, wild market swings. It stops a company from suddenly looking twice as valuable just because it's caught in a real estate bubble. The materiality principle, well, this is all about common sense. It basically says, don't sweat the small stuff. An accountant doesn't need to track every single paperclip. They focus on what's material, what's significant enough to actually influence someone's decision. Of course, this is where things can get tricky. Classifying a $1 million loss as immaterial to a giant company, that is a classic red flag for fraud. And finally, we have the conservatism principle. You can think of this as the better safe than sorry rule. If there's a chance of a loss, you record it. But if there's a chance of a gain, you wait until it is absolutely certain. This is what prevents companies from getting way ahead of themselves and booking revenue from some massive deal before the ink is even dry on the contract. So we've gone through the rules, but what's the big takeaway here? Why does all this grammar actually matter in the real world? Well, it turns out it's basically the glue that holds our entire financial system together. Look, when everyone follows the same rules, it builds trust. It lets us make fair, apples-to-apples comparisons between different companies. It creates real hurdles that help prevent fraud and manipulation. And all of that leads to better, more informed decisions for absolutely everyone, from investors to employees to lenders.
And that is the ultimate point. All these individual rules are just building blocks for one absolutely critical, overarching concept: financial trust. Because without that trust, the whole system just grinds to a halt. What's so vital to remember is that everything you hear about in the financial news, all those super complex standards like GAAP and IFRS that govern global markets, every single one of them is built directly on top of the simple, powerful principles we've just talked about. They are the true foundation.
And that leaves us with one last thought. We've seen how these rules create a system based on trust. So, what happens when that trust gets broken? When companies ignore these fundamental principles, whether it's by accident or on purpose, that's when you get the major financial scandals that shake our confidence and remind us just how vital this shared language truly is.